On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. There's been increasing talk of a US recession in recent weeks, with one major global bank suggesting the odds of this are as high as 60%. It's certainly possible if harsh tariffs remain in place, although the outlook could also brighten quickly if we see a de-escalation. Recessions are an inevitable part of the business cycle, and the 5 biggest US share market declines of the last 50 years all came during these periods. Recessions lead to higher unemployment, lower confidence, falling house prices, and a decline in consumer spending. This all feeds into weaker economic activity, putting pressure on corporate earnings and causing share prices to fall. There have been 4 US recessions since the 1980s. There was the 1990 recession, the one associated with the dot-com crash in 2001, the GFC from 2007 to 2009, and the lockdown-induced COVID-19 recession of 2020. The S&P 500 index fell heavily in all of these, and all of the 11 main share market sectors fell. However, the 2 sectors that proved to be the most resilient are consumer staples and healthcare. On all 4 occasions, they outperformed the broader market. That's not surprising. Companies in these sectors tend to be lower risk, more defensive, and less exposed to the ebbs and flows of the economic cycle. Consumer staples companies are in the business of necessity, and even during a recession, we still tend to buy shampoo and toilet paper. Demand for healthcare services also tends to be quite stable, and it's often one of the last things we'll scrimp on if we're forced to tighten our belts. At the other end of the spectrum is financials, which was the worst performing sector during those 4 recessionary periods. While banks find themselves in vogue with investors during buoyant periods, they aren't a great place to be during a downturn. Bad debts tend to increase and people hunker down rather than rushing out to borrow more money. After financials, the next worst performer during those past 4 recessions has been technology. That's a really interesting one, and the tech bulls will be quick to point out that these numbers have been dragged down by the dot-com crash 20 years ago, when the tech sector was belted. These days, some tech companies are almost like utilities, which could see them hold up much better during a rough patch. Few businesses, or consumers for that matter, could easily do without the likes of Amazon's cloud services or the Microsoft suite of products. Then again, the COVID-19 recession was an oddball one too. That period saw tech stocks perform very strongly because we were all stuck at home using online shopping and video conferencing. And in contrast to 2001, that example flatters the numbers for the tech sector in this analysis. Stocks like those in the Magnificent Seven have had a great run these last few years, and many of them are still very widely owned by investors. That could make them a natural source of funds if investors decide that they want to take more risk off the table. Looking at companies on a sector basis like this doesn't work quite as well here in New Zealand. Our market is much smaller, and the idiosyncrasies of individual stocks can really distort things. However, the same principles would apply. One would expect the larger, more stable companies to hold up better in any downturn, while those that are more closely tied to the global economy or those that have a greater dependence on consumer spending could suffer the most. If the US is headed for a recession, even a mild one, markets will remain under pressure. The best defence for investors is to hold a little more cash than usual to add to good quality fixed income and to ensure that your share portfolios are widely diversified with a tilt to those more resilient sectors. If you've got any questions, please get in touch with your advisor. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.